For decades, Japan's stock market was, let's be honest, a graveyard for capital. But what we're seeing right now, it's not just another market bounce. We are witnessing a fundamental, structural rewiring of the entire system. This is what we're calling the Great Re-rating, and it's being driven by a complete revolution in corporate governance. It's one of the most compelling investment ideas on the global stage today.
So after so many false starts over the years, the big question for any serious investor is, why is this time different? The answer is all about understanding the real catalysts behind this reawakening. Once you get that, you can see exactly how to capitalize on it. So that's the analysis we're going to break down right now. All right, our whole thesis here is built on 5 key pillars. We're going to start by really digging into the historical Japan discount, what it is, and why it existed. Then we'll look at the new reform playbook that's changing everything. After that, we'll check the data, see the real impact on shareholder value, and then lay out a strategy to find the winners. And finally, we'll look ahead to where the next big wave of opportunity is.
To really grasp how big this opportunity is, you first have to understand the scale of the problem. So let's start with those long decades of inefficient capital that created what we all know as the Japan discount.
For years, investors around the world used this term, the Japan discount, and it basically meant that Japanese companies were cheap for a really good reason. You had this corporate culture that was all about hoarding cash and keeping internal harmony, which came at the direct expense of generating returns for shareholders. Capital was just trapped, and valuations, well, they suffered badly as a result.
And the symptoms of this were just plain as day. First, you had companies trading for less than their net assets. I mean, just think about that. Second, this tangled web of cross-shareholdings that basically protected management from any real accountability. Third, these enormous, and I mean massive, piles of idle cash just sitting on balance sheets dragging everything down. And the final result of all that, chronically, painfully low return on equity.
And if you want to put a number on it, just to understand the scale here, as recently as 2023, over 40% of all the companies on the Tokyo Stock Exchange's top tier were trading at a price-to-book ratio below 1. That literally means you could have bought the company, sold off all its assets, and walked away with a profit. It was a just staggering level of capital inefficiency.
This really gets to the heart of the potential energy that was just stored up in the system. All that cash sitting on corporate balance sheets wasn't just unproductive, it was like a massive vault of untapped value, just waiting and waiting for the right catalyst to finally unlock it.
Well, that catalyst has finally arrived. And that brings us to the new reform playbook. Because this isn't just another small policy tweak. No, this time the approach is fundamentally, completely different. So yeah, the groundwork was laid over the last decade or so, but the real game changer, the moment everything shifted, was the Tokyo Stock Exchange's mandate in March 2023. It explicitly forced companies to get serious about their cost of capital and their stock price. We've officially moved out of the promise phase and into what everyone is now calling the delivery phase, a time where real, tangible results aren't just encouraged, they are absolutely demanded.
You know, the crucial difference here is the shift from form over to substance. The old reforms, they were just a box-ticking exercise. A company would add an independent director to the board, check the box, and nothing would actually change. These new reforms, they are all about outcomes. The TSE is now publicly naming and shaming companies that don't comply, which creates this powerful peer pressure. There's now a crystal-clear mandate to improve key metrics like price-to-book and ROE. And look, this isn't just our interpretation. This slide shows the policy shift, and the language comes directly from Japan's Financial Services Agency. It's totally unambiguous. The goal has shifted from simple compliance to creating real, sustainable value. This official backing is exactly why these reforms finally have some serious teeth.
Okay, so the theory is great, but is it actually working? Let's get to the proof. Let's look at the hard data, because the financial payoff is already becoming clear, and frankly, the numbers are pretty compelling.
So here you see the most direct impact. That giant hoard of corporate cash is finally being put to work for shareholders. In the 2024 fiscal year, share buybacks hit an incredible 18 trillion yen. That's almost double the previous record. And dividends, they're on a clear, consistent upward trend. This is exactly what you want to see.
But this isn't just about handing out cash. The underlying fundamentals, the core health of these companies, is improving. Since these TSE reforms really started to bite, the average price-to-book ratio has climbed from 1.1 to 1.4, and average return on equity has moved up from 8.4% to 9.0%. These are significant structural improvements, not just some cyclical market noise. And the pressure isn't just coming from the top down. Investors are not sitting on the sidelines anymore. Shareholder proposals have hit a record high for 4 years straight. Activist funds are getting in there, pushing for board changes, bigger dividends, and smarter capital allocation. It's like a pincer movement on management that they just can't ignore.
Okay, so we've laid out this really powerful macro trend. Now for the fun part. How do we translate this into an actual, actionable investment strategy? How do we find the specific companies that are going to benefit the most from this incredible tailwind?
The playbook here is actually pretty clear. We're hunting for a very specific set of traits. We want a company with a still depressed valuation, say a P/B below 1.5. We want a fortress balance sheet packed with net cash. We want to see those complex, old-school structures like cross-shareholdings that are ripe for being unwound. And, maybe most important of all, we want a management team that's just starting to see the light and embrace this new way of thinking about shareholder value.
And if you need one perfect example, look no further than Toyota. I mean, when one of the biggest, most conservative industrial giants on the planet announces it's going to unwind 3 trillion yen in strategic shareholdings, that sends a shockwave through the entire market. It's a massive signal that the old ways are over. No company is too big or too traditional to reform now.
So the changes we're seeing at blue chips like Toyota are huge, right? But they also point us toward where the next and maybe even more lucrative phase of this whole transformation is going to be. So let's look out to the horizon for a second.
The first wave of gains, the easy money, it came from the large cap companies. They were the obvious targets for the regulators and for big global investors. But the real analytical edge now, the source of future alpha, it's in the mid-cap space. We're talking about companies that are underfollowed by analysts, where the valuation discounts are still really deep, and that are just now starting to follow the path that the giants have forged. This is where a little bit of deep, bottom-up research can uncover some tremendous value.
So the crucial takeaway from all this is simple. The structural re-rating of Japan isn't some theory anymore. It is happening right now in real time. That Japan discount is finally being earned away through real substantive changes in how companies manage their capital. So the only question left to ask is, are you positioned for what's coming next?